I spent hours looking through data to make sure that we can find the best places to invest in property. Now, a lot of the time we're looking where we can make the most money and the best areas to make the most money. Now, what I want to show you in this video though are the best places to avoid. Now, I'm really lucky. I live in Wakefield, which is near Leeds. It's a great spot to invest. It's the north, but not just the north. It's an area where we're getting good capital growth. We've got good employment. We've got good commuter routes. But not all areas are equal across the country. And I know lots of people that are starting out in property are always interested to know where to buy property, but also where to avoid and what to avoid. I'm Simon. I've done over £10 million worth of property deals in HMOs, serviced accommodations and new builds. They've not always gone well, but what I have learned is where to invest and how to invest and the right strategies to invest in. And in this YouTube video, I will help you save money by not investing in the wrong areas or the wrong type of stock. One thing that I found with lots of YouTube channels and gurus is they tell you to invest in certain strategies in certain areas just because the numbers as a headline look really exciting and juicy, but that's not always the case. We can't invest in property purely through AI, and we can't purely invest in property based on headline numbers. We have to understand more detail behind those headline figures, and that's what I'm going to try and do today. I tend to find that lots of people are looking for high yields. What are the high yielding areas and what are the high yielding properties? High yield doesn't necessarily mean great investment. So you could get a high yield from a serviced accommodation property. You could get a high yield from buying in certain areas of the northeast. You can get a high yield from investing in HMOs. Now that doesn't necessarily then mean that you're going to get a great return over a long period of time. And also the three that I've just mentioned there aren't going to get the greatest capital growth, which is where you make 70% of your money. Area one that I'm not investing in at the moment is holiday hotspots. I understand this is a category as opposed to a single city, but there's also a strategy that I'm avoiding at the moment too. So we're looking at the Cotswolds, Brighton, big chunks of Wales, anywhere around the Lake District. Basically anywhere that boomed during lockdown, where we are UK holiday pretty hotspots type places. 2 years ago, everybody wanted a piece of the serviced accommodation holiday home pie. We were still holidaying predominantly in the UK, which made a big difference. And then also we wanted to make massive profits by letting our properties out on booking.com or Airbnb. The tide has very much changed, and once again thanks to the government in some cases. In 2025, the government scrapped the furnished holiday let tax scheme. This is where if you had a holiday let, you could deduct the full mortgage interest payment. It was a tiny bit of a loophole around Section 24, which the government shut quickly. So now you only get a 20% credit as opposed to being able to deduct the full interest amount from your income. So for the higher rate taxpayer, if you own a holiday home in your own name, it absolutely kills this strategy. You are paying massive amount of tax on the turnover you make on this business. There's also no more capital allowances on the furniture kit out, again, if you have that in your own name, and there's no more counting your profits as a pension contribution earnings. Basically, this strategy was a great strategy for lowering and getting around a lot of tax loopholes. They have all been shut. So from a tax perspective now, it doesn't make a lot of sense, especially in and around your own name. Slightly different, a limited company, but in your own name, a lot of the tax benefits have gone. That is the case across the board in property. There are now also a lot of councils, especially in these holiday home areas, that are charging 100% second home premium on council tax as well. They really don't want investors to come from out of town, buy these properties and use them to let them out as holiday homes. They're desperately trying to stop this. So if you are looking to invest in these areas, in the likes of the Lake District, in the likes of the Cotswolds, in the likes of Cornwall, where the holiday home strategy, the serviced accommodation strategy was working and you had these properties in your own name, a lot of those loopholes are shut. Also, running these types of property is a second business. It's a hospitality business. So you don't become a property investor as much. You are also then running a hospitality business where the tax advantages are gone and you are having to run it as a business. You have to make sure that the houses are clean and tidy. You have to run staff, which is the cleaning staff. You could get a management company, but they would take a chunk of money from it. So the attractive nature of investing in these areas to get premium rents, if you will, or premium income because of the serviced accommodation model, a lot of that has gone. And then if you're looking to invest in these places for capital growth, the barrier to entry to buy into these places is a lot harder because the purchase price is a lot higher. So you're not able to leverage your cash in the same way as buying in areas that are seeing great capital growth in northern towns and northern powerhouses. So for all of those reasons I've mentioned above, I am not investing in holiday hotspots. Area 2 that I'm not investing in, and this is a real big one for me, I feel really passionate about this because I get asked this a lot. I am not investing in cheap areas in the north. I get sent these by people that are like, what do you think of this site? I'm not investing in Middlesbrough. I'm not investing in Grimsby, Hartlepool, Barrow-in-Furness, where the yield on paper is massive and you could buy an house for about 50 grand, but you're always going to be able to buy an house for 50 grand there because the property prices are never going to go up. And let me tell you why. When you are looking to invest in these cheaper areas, you've got to look at the last 10 or 20 years. There's been no property price growth. There can't have been for the property to be still worth 50 grand. There's no industry. There's no employment. There's no commuter routes. There's no reason for people to want to live in that area. So the demand is very low. The supply is pretty consistent and therefore property prices aren't going up. It's very basic economics that when we inversely look at that, we're looking to buy in areas where the property prices are going to go up. The extreme example is London. The reason that London property prices are so high is because there's so many people that want to buy and invest in those areas. The reason it is so low in the likes of Hartlepool is because no one or very few people want to live there. And big industries like the steel industry, for example, have moved, and they aren't going to come back. And for a long time now, there aren't reasons to live in those areas. ONS data released in December 2025 showed that Hartlepool house prices grew by 1.3% last year, which is less than inflation. So if anything, they're actually going down in price, not up. And the Northeast region as a whole, which has a few towns that will pull it down, only grew by 4.6%. And I bet cities like Newcastle really made that as an outlier and raised that average house price growth as well. Along with cheaper properties, you're likely going to rent out at a cheaper price, £450, £500 a month. The yield looks amazing on paper, 10% gross yield on what I've just mentioned, but you're likely to get tenants of a similar standard. You're going to get people that can only afford to live in those areas, which means people aren't going to pay. They're going to damage your property. You'll have high tenant turnover because there's no reason for people to live there. There are a million reasons why I would not be investing in Hartlepool, Middlesbrough and Burnley. High yield doesn't necessarily mean great investment property or area. So I am scrapping out the areas that I've just mentioned, but poorer, cheaper areas where you can buy properties at £50,000, £60,000. It's not for me, and I suggest it's not for you. Area 3, on where I'm not investing at the moment as well, is Scotland. On paper, Scotland looks quite a good area to invest. A recent Knight Frank forecast has suggested that there's going to be a lot of property house price growth in Scotland and some really key areas that are going to see a lot of capital growth. Rents have also been rising at a very fast rate too, but there's an underlying reason for both the rent rise and then both in turn why we don't want to invest there. Scotland have been raging war against landlords for a long period of time now. They have had rent freeze rules in certain areas. They've passed another bill that means there can be more control by local governments to put rent freezes into place and stricter ones that are in place already. By 2027, they'll be able to cap all rents across Scotland, and the only way you'll be able to raise is CPI plus 1%. So the consumer price index, so inflation plus 1%, will be the only amount you're allowed to increase rent by, which will come to a hard maximum of 6%. So even if we went into an inflationary period, you could then only top out your rent increases by 6%, which may not be even enough to manage against your interest rates and what you are borrowing against that property. Institutional money in Scotland has already voted with their feet. 9 out of 14 of the big institutional investors that were investing in Scotland property have left the market. That is the most experienced investment money on the planet, and they are leaving the Scotland property market. And for me, if those with big legal teams and big firms can't make Scotland and managing Scotland tenants work for them, then I certainly aren't investing in that area. The political risk and what looks like it's going to happen in the future is just too much of a hassle for me, and I'm not investing in Scotland for that reason. Area 4 of where I'm not investing, and the last area now, is the southeast commuter belt. And predominantly that bottom right-hand corner of the UK in and around London. Now, might sound a bit mental because you're like, oh, well, London property prices continue to rise and they're having a little bit of a resurgence again after having a flat 10 years. and you're thinking, well, anything around there could see some great capital growth. And some of it I don't disagree with. However, the average house price in this area that I'm speaking about is £441,000. If you're looking in the Surrey region, it's well over £600,000. So you've got some of the most expensive stock outside of the M25 ring, but you don't necessarily have London's prestige factor and their massive rental prices. You're also getting hit from multiple angles. Buying one of these investment properties will hit you massively with stamp duty. Now we've got this extra 5% on top. On a £400,000 investment property in this commuter belt, you are going to be paying £30,000 in stamp duty day one. That is a huge amount of tax before you've even owned the property. And because of this reason, amongst others, it is taking an extra 30 to 60% of time to sell that property. If you only want to get rid of that, crystallize some of your returns, investing in another area, you've got to factor in a huge amount of time to sell that property too. The other big problem I see in this area is the ceiling of house price growth. Whereas I see in Leeds and Manchester a lot more room for house prices to increase, I can't see that for the near future in the southeast. I'm also finding that a lot of rents don't match up from a yield perspective against the house price. So our gross yields are not high enough to cover some of the debt ratios that we have. So if we combine all of this together, I am definitely avoiding the southeast commuter belt. So there's your 4 holiday hotspots: cheap northern towns, Scotland, and the southeast commuter belt. They are areas that are not good to invest in property. And this is where property is not a one size fits all. We could buy in the north, low entry points, low price points, and high yields. We could buy in the south, buy more expensive properties with lower yields. But neither of those strategies, as an extreme example, work for some of the reasons I've mentioned above. But like I always say, don't just look at yield alone or house price alone. There are lots of different ingredients to make a great investment property. If you'd like more help on finding good investment areas, please comment below. I'm always happy to answer questions. And also, if you need help in mentorship or in some guidance in investing in property, please click on the link below and book a call with me and my team, and we can get you started in investing in property. We're really interested in helping professional people that want to keep their job, that want to carry on working in their day-to-day job, but start investing in property on the side. Property is a great investment strategy. I really believe in that. And I'm here to help people not just buy any investment property, to buy great investment property. I look forward to seeing you in the next video.